a couple of things. One, if I can finish all the slides today, then I'm thinking about having a class next Tuesday, the valuation chapter, and no class on Thursday. Then on the next Tuesday, you're going to have the exam. So on that Thursday, I might have office hours. So if you study in advance, you can ask me questions. Another thing is videos are being put on the internet. The first week's class is already there. I'm going to send you the link. And before the exam, probably we are going to have the capital structure weeks, 2 weeks of lecture as well. The payout part is blah, blah, blah. You can read it anywhere. And I put the sources I'm using. So if you want, you can read those chapters. And then we have valuation left. I don't think we will have many slides in the valuation part. So I think we can finish it in 2 hours. And today I will definitely try to finish before 6. But if I have like 5 slides left, if it is 6, I will continue, of course. But I will try to finish before 6. OK. We talk about what dividends are, what is dividend yield, dividend payout, total payout ratios, and everything. There are other types of dividends as well. So there are stock dividends. So basically what happens is companies give each shareholder additional stock. For instance, 100 stock dividend means you have 1 stock on top of every stock you have. Okay, so you get 1 more share. 50 stock dividend means you have half a stock for every stock you own. So stock dividends are like stock splits. And I'm going to give you an example later. 100% stock dividend equals to 2-to-1 stock splits. So for each stock you have, you're going to end up with 2 stocks. For 50% stock dividend, it is 1.5-to-1 stock split. For each stock you have, you're going to have 1.5 stocks. No value added by the dividend payment. Okay, it's going to change the stock price, of course, but it's not going to change the value of the company. So basically, the stock price will decline, but stock price numbers of shares will increase, and stock price will decrease. So the total effect will be nothing. There are also property dividends. These are really interesting. These are very rare. Made up example, if you have Heineken stock, for instance, they're sending you a case of beer for every 100 shares. But there are real-world examples as well. Wrigley's gum, they send a box of chewing gum to the shareholders. So there are property dividends as well. OK, let's look at this simple example on stock dividends. Imagine a corporation. It has 10 million shares outstanding. And it is sold at $60. And it declares 3-for-2 stock split. So for each 2 stocks you have, you're going to end up with owning 3 stocks. Okay? So after the splits, how many shares will be outstanding? There are 10 million shares outstanding. Because of the 3-to-2 ratio, the company will have 15 million shares outstanding. But the stock price will be influenced as well. The stock price will decrease to $40 per share. Very simply, why do you think companies might do stock dividends or stock splits? Anyone else? OK, yes.
For example, the Apple shares, it's just like traded at the 600 or so. So to make it more available to investors, they choose split.
Exactly. If the stock price is too high compared to the competitors, it might be a trouble for the company because investors might not afford the stock. So to decrease the stock price without changing the value of the firm, this is what companies might do. Exactly. OK, we might also see spin-offs. So what happens is a new company is generated, and the parent company investors are paid by new company's shares. So parent company shareholders own parent company stocks and also the subsidiary stocks. And we see that in the Travelers and Citigroup case or Kraft and Altria Group case. This is another way of distributing money to shareholders. So they are giving shares of their subsidiaries, let's say. Another thing, something popular, has become popular in US is DRIPs, dividend reinvestment plans. So basically, companies allow shareholders to invest their dividends on the company again. Why is it good? Because normally you get your dividend payment and then you have to pay commission and what have you to buy stocks. But with dividend reinvestment plan, you're not paying any commissions and you're buying more of the company. So this is good for both parties. And to see why it's important, so if you are getting $30 in dividends in a quarter, when there's an $8 commission to invest the money, you will just prefer to be in dividend reinvestment plan. So you can just pay. You can use that $30 to buy more stocks in the company. This was another reason why when I ask you, would you prefer a dividend-paying stock or not? As you can see, you can get the dividend and make more investments. And with a DRIP plan, you can, if you're happy with your company, if you're happy with the future prospects of the company, you can reinvest in the company without any commissions. So this is getting very trendy in US. Taxing. We talk about capital structure and we talk about how taxes are important. I'm going to touch base dividend taxation now, and then at the end of the class, again, I'm going to go back to taxation of dividend payments because they're important. There is double taxation in US companies for dividends. When I say double taxation, what am I talking about? Companies pay taxes on their taxable income, right? Think about the income statement. There's earnings before interest and taxes. Then the company pays interest, and then we end up with EBT, equivalent to taxable income. From that taxable income, tax is paid to the government. So the corporations are paying tax to government at around 35%. And then net income, we find the net income, and then dividend payments are made to stockholders. In that case, as stockholders, we have to pay taxes on the dividend payments because it is it's increasing your income. So because of that, we say there's double taxation in US. So how do you think this tax will affect the value of stocks? In a positive way or in a negative way? So this tax goes to, when I talk about value of stocks, I'm talking about value to shareholders, right? So when shareholders are paying taxes, what happens? Are they left with less money or more money? Less money. So it should affect the value of stocks in a negative way, right? Because the tax is going to the government. And we're going to see theories about it as well. Okay, let's look at this example, just mathematical representation of what I just said, combined with how pension funds are getting favorable treatment from governments. Suppose that we have two investors, one individual investor, one pension fund, and they both invest in the same company. Operating income is 100 for both. Of course, the company pays corporation tax, 35%, and they both get the remaining part as a dividend payment, no retained earnings. But as an individual investor, we have to pay tax on our dividend payment, which is around 15% in US. But pension funds, they're kind of required to buy income stocks. On top of it, they get favorable tax treatment. So they don't pay tax on the dividend payments. And as you can see, the cash you receive is $55, whereas for pension funds, it's $65. So there's the effects of tax on individual investors as well as pension funds. We are talking about dividends. Let's look at what happens when there's a dividend cut. Of course, there should be a negative or positive reaction when there's a dividend cut. Negative. It should be negative, of course. And average decrease in share price is around 4%. Average loss in the market value of equity is around $30 million. And this is from a study by Lee and Lee. The second Lee is Eric Lee from the University of Iowa. He was my professor. And actually he got, I always advertise him, not that he needs it, but he was in Times 100 most influential people list when I was there. Not because when I was there, but it's because he wrote a paper about stock options and backdating. I will talk about it in the corporate governance part of the class, actually. Very nice guy. Okay, interesting thing is the second part. When companies need to make dividend cuts, yeah, dividend cuts are bad. You know, you see bad market reaction. When companies have to make dividend cuts, that's interesting. They cut dividends really a lot. What I mean is, so suppose that they need to make a dividend cut. They say, okay, we have to make a cut anyway, and there will be bad market reaction. So let's make the cut really big. So when you have bad news, give really bad news to investors. And this is actually not surprising. There are lots of studies which look at different bad announcements. And this is the general consensus. This is what we see in real data. When CEOs have bad news, they try to give all of them at the same time, not spread it over time, so that you will have one bad market reaction, then things will get smoother. And on average, post-cut dividends are around 60% of the pre-cut dividends, which is a big number. They're cutting 60%. And dividend cuts average 60 times the size of the dividend increases. Why do you think they're very conservative when they increase dividends, but very relaxed when they're doing dividend cuts? Which one is more sustainable? Making huge increase in dividends or dividend cuts? Huh? Exactly. If you increase dividend payments, you make a huge increase in dividends, it's not that sustainable. You have to stick with it all the time. So in this case, they say, okay, we're going to make the dividend cut really bad, then things will go better. But if you increase dividends a lot, then you have this long-term problem. Are you going to be able to keep it in the long run as well? An interesting thing, Lee and Lee show that they look at average abnormal returns, how markets react to dividend cuts throughout time, from 1963s to 2000s, let's say. As you can see, market reaction gets less throughout time. One question I'm going to ask, when it says abnormal return, what does it mean? Abnormal return. You know how to calculate return of stocks. It's here. This is the return. Dividend, price change, compared to the initial price. What is abnormal return? Yes?
Is it more than expected return, or maybe less?
When you say expected, okay, you're comparing your company's return to a benchmark. Generally, we use the market return. So, are you getting return on top of the market return or less than the market return? And this is what we generally do in academia, okay? Why are we comparing with the market? Because we want to smooth out all the market crisis, right? Seeing a stock decrease in a bad market doesn't mean much. But having a stock decrease in a good market is a bad thing, right? So you have to smooth out the market effect. Did you get what I just said? Okay, perfect. Okay, so people are reacting less and less to dividend cuts throughout time. Why? Maybe because investors are becoming more informed. They are looking at the reasons why there are dividend cuts. Maybe there's a really good investment opportunity for those companies. That's why they're cutting the dividends. But this good investment will turn into long-term long-term wellness of the company. In that case, it's not bad. So maybe we are becoming more informed about our investments. So we are giving less reactions to company announcements. Okay, so we spend a lot of time on dividends, there is also the share purchases part. Let's go over share purchases. So another way of distributing cash to shareholders is share purchases. Again, board of directors decides on it, and they decide how many million of shares will be repurchased over time. And what happens is, I, as a company, let's say, I repurchase stocks from you. I pay cash, and this generally takes place in what kind of market? Primary, secondary?
Secondary?
It actually depends. We will see. Share purchases have become more common in the US history. And I showed you this graph before. Share purchases as a percentage of total payouts increased over time. Okay, how do shareholders benefit from it? What happens? So the firm repurchases stocks. We pay shareholders cash, and then this stock becomes treasury stock, as Ahmet said in the first lecture. And what happens is the remaining shareholders who choose not to sell their stocks, now you own larger portion of the company, because treasury stocks are not voted as or are not counted as ownership in the company. So people who didn't sell their stocks own larger shares of the company now. So you will get larger cash payments in the future because you own more of the same company. There are different ways of doing share purchases. One is open market. So the company just acts like any other individual, and they go into the market, buy the stock at the market price. The second one is tender offer. In that case, company gives a higher stock price. It pays a premium over the market price to make the share purchase more attractive, right? So instead of paying the market price, like in the open market case, the company is paying more money to investors. There's Dutch auction. Econ people will like it. So basically, the company gets bids from shareholders, form a demand curve, and then pick the lowest price. And according to how many shares the company will buy, the company picks that low price. That's the Dutch auction. The last one is direct negotiation with large investors. So they just purchase from large investors. One example of it is green mail. That's interesting, and we're going to talk about it in, I think, governance section. Green mail is kind of like blackmail. So what happens is there's this target company, and let's say I'm the CEO of this target company, and for some reason another company wants to buy my company. So what I do, or starts buying my company, it's an hostile action. So little by little, that company is buying stocks of my company. I go to that acquiring company and I say, look, I'm going to buy stocks from you at a premium. So I'm kind of blackmailing them not to buy my company. So this is an example of how CEOs can negotiate with large investors. Okay. Why am I blackmailing or greenmailing the acquiring company? I mean, very straightforward. I'm the target company CEO. Alican wants to buy my company, and I'm telling him, okay, I'm going to buy stocks at a higher price than you, so just leave me alone.
Keep the control.
I want to keep the control. And the reason why actually companies are being acquired is it's because one reason might be, again, an agency problem. Maybe I'm a really bad CEO. Probably not. But maybe I'm a really bad CEO, and Alican says, I can manage this company better than her. So I will use whatever the company has. So I should just give the opposite example. You know, you should be the bad CEO. I should be the good CEO, whatever. Okay, so he says, okay, there's really good value of the assets of this company. So just the manager is bad. So I will just I will use my CEO skills, and this is going to be a good investment. I want to keep my job. Interesting thing, a study actually showed that in normal acquisitions as well. Two companies start negotiating, and of course, target firm gets some premium. Otherwise, target firm shouldn't sell itself to the acquirer, right? So I should get something from this acquisition. A study showed that if, for acquisitions where the target CEO keeps a seat in the board of directors of the merged firm, the premium paid by the acquirer is less. I'm kind of buying my seat in the new company at the expense of my stockholders, right? I'm getting less premium from the acquirer just to be able to get a seat in the merged company. So you shouldn't trust CEOs, okay? They know too much, okay? Oops, what did I say? Okay, so how do you use, why are we using share purchases? I told you the problem with dividends. Dividends are sticky. Companies cannot change their dividend policies much, but share purchase is a one-time only thing. So in that case, companies might just prefer share purchases when they don't want to see a big negative reaction from investors. And it's also good for shareholders. Why? Because they don't have to pay tax on dividends like in the share purchase. I mean, of course, they pay capital gain tax if they get a high price compared to what they paid for the stock. But anyway, they can get that money and spend it on another investment, for instance. Okay. We looked at this before. So what we saw from here was generally companies pay out more cash to investors as we move in time, and share purchases are becoming more popular. Now let's just summarize what we talk about, and it's actually from Lintner's 1956 paper. We went over all of these actually before, but let's just summarize things. One, firms have long-term target dividend payout ratios. Mature firms have high payout ratios. Growth firms have low payout ratios. We talk about it because growth companies need money and they don't have much cash inflow. Managers focus on dividend changes rather than the absolute levels of dividends. Okay? So a dividend cut or dividend increase is more important than keeping the dividend level fixed. Dividend changes follow shifts in the earnings. Like as the earnings increase, you expect dividends to increase as well. So short-run fluctuations in the earnings don't change the dividend policy much. Why? Suppose that you have a bad earnings. On top of it, if you make a huge dividend cut, you're going to have you're going to see a really bad market reaction. And if you think you can reverse things in the following year, why are you cutting the dividend? You don't need to do it. So dividend payments are smoother compared to earnings. Another thing we talk about, managers are really reluctant to make changes in the dividend policies. So if they announce a dividend increase, a big dividend increase, they might need to change it in the future, and they don't like it. And because of that, managers are very conservative about dividend policies. We saw that dividend cuts are bad market reaction. And a company cannot increase, or a manager cannot fool the investors all the time increasing the dividends, right? Because as a CEO, you might just say, okay, I'm going to announce an increase in dividends, and everybody will think we're doing great, we're going to have lots of cash flow, and I'm going to signal something good. But it's not sustainable, okay? You cannot fool the investors all the time because you have to make cash payments too, and you cannot create cash by magic, okay? You can increase earnings with magic, but not cash, okay? And firms repurchases for two main reasons. One, if a company has lots of cash, they need to return that money to shareholders. And another thing is maybe, we talked about capital structure and leverage ratios before, maybe the company has very low leverage ratio, and if the manager wants to increase the leverage ratio, share repurchase is a good way to do it. So they're basically they are buying back stocks from investors, and automatically leverage ratio will increase. because equity is decreasing. Now let's look at the information content of the payout policies. So I talk about them little by little in the first hour. So now we're going to look at what kind of information content we have in dividend payments or share purchases, how the market reacts to those. I think this is the part you're interested in, more realistic stuff. And we are going to see whether those changes in the market stock price will affect the CFO action. Okay, the first thing, the first very important thing is dividend signal cash flow and earnings quality. Okay, so what it means is, I just said that you can manipulate earnings legally or illegally. Okay, there are ways to do it, and we talk about it in the first week actually a little bit. But cash is not very easy to manipulate. So a company can inflate earnings, but the company cannot go on paying dividends without cash it doesn't own. So that might be a problem. And if this happens, then there should be a dividend cut. And having dividend cuts or trying to finance those dividend payments with debt or equity is really expensive. So instead of it, managers are going with more reasonable, sustainable dividend policies. And in general, we can say a company paying dividends signals good earnings quality. Okay, because the CEO thinks earnings will continue to go sustainable and they will be able to make the dividend payment. And investors react or take the changes in dividend payments in different ways. We talk about it. If there's a dividend cut, it means the company is in trouble. So there will be a bad reaction from the investors. If there's a huge increase in dividends, then people will say, okay, that's a good thing. The company is doing well. So we might see an increase in stock price. So in general, and another thing is a company paying no dividends start paying dividends. So we see an average 4% increase in the market when a initiates dividend payments. This is an example of how market reacts to dividend decreases or dividend increases from the study of Roni and Swari. These are cumulative abnormal returns. So as you can see, when there is a dividend decrease, there's a huge, not huge, but there is a negative price reaction by the market. And when there's a dividend increase, we see a positive market reaction by the market. So dividend cuts are bad, dividend increases are kind of good. Another thing about dividend payments is that we talk about institutional investors. And institutional investors buy what kind of stocks? Huh? Income stocks. Stocks which pays lots of dividends. In that case, we can also say, okay, these are big investors. It's not like you and I, right? These are very informed investors. So they closely monitor those companies. So you can say, if a company decides to pay lots of dividends and become an income stock, the CEO agrees to be more transparent or agrees to have more monitoring from institutional investors. So in that case, again, a dividend payment or high dividends they're a good thing, right? Because there will be more monitoring. When you look at the share purchase case, it's, as I said before, it's a one-time commitment. So it's not like dividend policies that you cannot alter that much. So firms basically repurchase shares when they have lots of cash and when they want to increase leverage. So the question is to you, is for you. So why? I mean, both of those things are actually bad, like the company increasing leverage or the company has lots of cash. Why do you think the market stock price increased by 2% on average when there's share repurchases? Yes?
We buy the stocks by thinking it will increase in the future as an investment. And this is actually the same for the companies. If they repurchase their stocks, they think that those stocks are undervalued and they decide to buy it.
remember we talked about issuing stocks, and we said the company CEOs generally issue stocks when their stock is overvalued or undervalued. They issue stocks overvalued when they can get a high price from it. This is just the opposite. Share purchase case, when the CEO thinks that their stock is undervalued, they're going to do a share purchase. Remember, they're generally on general day in the tender offer, they pay more than 20% on top of the market price. So they have good prospects, good expectations about the future of the company. So that's definitely one thing. Another thing is the agency problems. Remember, I always talk about it. If a company has lots of cash, we might have agency problems. Okay, it might be the CEO not making enough investments. It might be the CEO spending the money on his own interest. So all those things will create agency problems. So we can say that share purchases are taken as a good thing because of those two things. It should decrease agency problems, and it also shows what the CEO thinks of the company. So the CEO thinks it's undervalued. So as you can see, I gave you some examples of how market reacts to changes in payout policy, and you can we see that for the market it's important. All those information is important, but the question is, do you really think the payout policy can change the value of the firm? And for that we have theories, like we had in the capital structure. And just like in the capital structure theories, we have a controversy here. And in academia, we love controversies, so we can write more papers. So some people say dividends are good, you should pay dividends. Some people say dividends are bad. Some people say dividends are irrelevant. Guess who says dividends are irrelevant? Modigliani and Miller. For them, everything is irrelevant, right? Okay, so with Modigliani and Miller, they say, look, the firm value is based on the assets. Companies actually issue stocks to pay dividends. And in that case, there's no wealth creation. Then there's a follow-up idea or study of Miller, Black, and Scholes. You're going to be very familiar with Black and Scholes in the options part. We're going to see them in the options part. They confirm the same thing. They say value is not created, paying dividends. Then there are people who say dividends are good. So the reason why they say dividends are good is because of the things we talk about. Investors like income. You can get the dividends and make investments, or you can get the dividends and you can do consumption. Dividends are good. Also, when there are dividend payments, there's less agency problems because there's less money in the company. So the CEO will be more careful about which projects to choose. And then the dividends are bad people. So basically they say, because of the taxing, because some money goes to the government, actually dividends are destructing the value that should go to the shareholders. And we're going to look at all those things one by one. So let's start with dividends are irrelevant people case, Modigliani and Miller. Suppose that we are thinking about companies which has fixed investment and borrowing plans. So we are not changing capital structure, we are not changing investment decisions. And the firm needs a certain amount of cash for the investment. And this comes from borrowing, and some cash comes from retained earnings, and some excess cash is generated, and this money is paid out as dividends. So if the company wants to increase dividends, where the cash will come from? All the money is used for investments. Okay, there's no money left. In that case, the company should issue new stocks. So what happens in that case is the total value of the company will not change. Why? Because we will just see a transfer of ownership from old stockholders to new stockholders. No change in the value of the firm. Remember, we are looking from the firm's perspective, not the old shareholders, new shareholders' perspective. So let's look at this. So this is the Modigliani-Miller case, okay? So this is the total value of the firm. They assume total value of the firm doesn't change. So this is the value before dividends. This is the value after dividend. And these are the total number of shares. So before the dividend payment, so this is the worth of each share. Okay? And after the dividend payment, suppose that new stock is issued. This is the basis of their assumption. New stocks are issued to finance the dividend payment. So now, as you can see, we have more shares outstanding. The total value of the firm is fixed. Now what happened is the value of the value that goes to old stockholders actually decreased compared to before dividend case. And since there was stock issuance, new stockholders get some value from the company. Overall, there was just transfer of ownership from old stockholders to new stockholders now. So the total value didn't change. So this is the basis of Modigliani and Miller. This is another example of looking at the same thing. I changed the order of slides a little bit, so don't get confused. It's the same thing. Okay, this is Iowa City Inc. balance sheet. So suppose that the company has $1,000 cash. It's held for investment. $9,000 worth of fixed assets. There's some investment opportunity. It's going to create some MPV value. So total asset value is $10,000 plus MPV. Since this is a balance sheet, you should see the firm value on the right-hand side as $10,000 plus MPV as well. Suppose that the company doesn't have any debt. In that case, all the value is the equity value, $10,000 plus MPV. So in this case, suppose this company wants to pay dividends of $1,000. And this money will come from where? It's going to come from issuing new stocks. So in that case, what's going to happen is, since there's no change in the fixed asset part, all the changes will come from basically just dividend payment and issuing stock part. So in that part, the value of the total market value of the firm will still be same. It's going to be $10,000 plus MPV. But look at what new shareholders get, what old shareholders get. New shareholders will have $1,000 of the value, all the stock issuance. And the old shareholders will have $9,000 plus the MPV. But on top of it, old shareholders will have dividend payments of $1,000. So as you can see, when you look at the total value, it's going to be fixed $10,000 plus MPV. Nothing changes. I know it has lots of assumptions. It's not very realistic. But this is the world of Modigliani and Miller. Do I have the... OK, I don't have it. But just like in the capital structure part, they have lots of assumptions about this world. So it's a perfect market, full market efficiency, which is not realistic, but it's a way of looking at things. OK. Another thing, if you want to look at decreasing dividend case, before I showed you dividend payments. If it is the case, then what's going to happen? Again, investment and borrowing decisions are same. So because of the dividends cuts, there will be extra cash. And this extra cash will be used by I forgot the word. Okay, buying stocks from shareholders, for instance. And in this case, again, there will be no change in the value of the company. So dividend increase or dividend cut, it doesn't matter. Total value of the firm doesn't change. As I said, they have lots of simplifying assumptions. Like, again, there's no taxes, no cost of equity, nothing. The changes in assumptions might make dividend policy more relevant, actually. OK, Miller, Black, and Scholes, again, they support dividends are irrelevant theory. And they look at the supply case. Basically, they say if firms can increase their stock price playing with dividend increase or decreases, they would do so. Dividends are at those levels and they don't change much. It's because changes in dividend policies doesn't affect the market value. Think that way. If a company can increase its value by increasing dividends, they would do so all the time. They will try to do it all the time. But we don't see it. Why? Because changing the dividend policy doesn't affect the value of the firm that much. So this is what they're saying. And they say there are different firms with different payout ratios. So there's demand and supply. There are investors who prefer certain types of firms, and there are firms which have certain types of payout ratios. So it's win-win. We are in equilibrium. So dividend policies are irrelevant, they say. Let's move to the dividends are good camp. So basically, they say there are institutional investors. There's a natural clientele for high dividend stocks. Like we talk about pension funds, there are university endowments. They buy from companies which pay lots of dividends. Retired individual, for instance, we talk about them. They live on their income on dividend payments, for instance. And behavioral finance people actually say people like income from dividends because they don't want to make decisions themselves. Remember I said dividend payments are good even for young investors. Why? They can get that dividend payment, look for another investment, and just make more investments. But most people, like behavioral finance people, actually proves that people don't want to make decisions. So it's okay. It's better for you to just get the dividend payment and spend the money, for instance. So for those reasons, there are some people who say dividends are really good. Another reason why we said dividend payments are good is because of reduced agency problems. We talk about it. If a company has lots of cash, the CEO might invest in negative NPV projects. It might be an empire builder. Just the CEO wants to manage a very big company. So the only thing it's important for the CEO is making the company big, which means make lots of acquisitions, bad or good. And by regular dividends, by paying out some money to the shareholders, actually CEOs can be more careful about what investments they are choosing, and they might be interested in creating value. The last theory on payout policy is the dividends are bad camps, and the reason why they say dividends are bad is because of the taxes. So I'm going to spend the remaining part talking about taxes a little bit. So as I said before, there is double taxation in US. Corporations pay income taxes to the government, and then when you get dividends, you should also pay tax to the government because of that. And also, even if there's no dividend payments, when you sell your stock, if you sell the stock for a higher price compared to the price you paid for the stock, you have to pay capital gain tax to the government as well. Okay, so the people who say dividends are bad says, investors should have all the cash. Why are we giving the money to US Treasury in the form of tax? Okay, and those people say companies shouldn't pay lots of dividends because the government is enjoying it, and this is actually bad for shareholders. And if the company needs to return money to shareholders, then they can do repurchasing instead of dividend payments. Okay. Things that are important here is, so if I'm paying tax on dividends, then I should prefer dividend-paying stocks less compared to non-dividend paying stocks. And when I buy stocks from dividend-paying companies, much of the value will be going to the government. So the thing I need to look at is actually I need to compare the tax rate on the dividend payment and the tax rate on the capital gains. And if the tax rate on capital gains is less than the tax rate on dividends, then I will I will accept a lower return from securities paying low dividends. So it's just when are you going to be better off? Getting dividends or just enjoying being stick with capital gains? Okay. So let's look at an example we have here. We have two companies. I changed the names. It's A and B now. And suppose that there's this tax system. It taxes dividends at a higher rate than capital gains. So you pay more tax on the dividend payment. Okay, A and B have the same risk characteristics. A pays no dividend, B pays dividend. Investors expect the price of the A to be 111.5, and investors expect the price of B to be 102.5. Okay? So they expect the price of B to be less than A, but be careful, there's a $10 dividend payment, so together it's actually their equivalent, 112.5, right? $10 dividend plus the price. So let's look at what investors are willing to pay for those stocks. Okay, so for A, next year's price is 112.5. Help me with this, because I'm going to ask you where these numbers will come from, because I might get confused. So next year's price is 112.5 given for A. Dividend pay, there's no dividend payment for A. So pre-tax payoff is 112.5. So if you sell your stock, this is what you're going to get. Today's stock price is 100, let's say, for the no-paying company, no dividend-paying company. So how do I calculate the capital gain? How do I calculate the capital gain? What is capital gain?
Price change.
Change in price, exactly. So the next year's price is 112.5. Today's price is 100. So you get the capital gain of 12.5. So rate of return on this will be how much? Stock price is 100. Capital gain is 12.5. So it's 12.5%. This over this, right? That's it. Okay. So since there's no dividends, there's no tax, so there's zero. You get 20% capital gain tax. So you pay tax on this 12.5, right? Okay. So total after tax income is how much? You get 12.5 capital gains tax minus the money that goes to government. So you have $10 after tax income. Okay, so after tax rate of return will be 10 over 100, so 10%. Right? Let's look at the same thing for B. So next year's price is 102.5 with $10 dividend payment. So total payoff is what? 112.5 stock price plus the dividend you're going to get. Today's stock price is lower for B. Why is it lower for B?
Because it will appreciate to 102.
Sorry?
Because it will appreciate to 102.
Okay.
Because they
Anything
pay
else?
Dividend tax.
Okay, good. I think it was in the next slide, if you have the slides. Okay, let's continue. And we're going to answer it in a second. Okay, so today's stock price 97.78. What is the capital gain? It's the difference between next year's price and today's price, right? 4.722. Rate of return is 15%. Where does this come from?
Dividend plus capital gain.
Thank you. Don't forget the dividend. You have the capital gain plus dividends over the stock price. So it should be 15%. What I have in the board is what we just did. Okay? Capital gain plus the dividend over the stock price. 15%. So you pay 40% tax on dividends, which is 4. You pay 20% on the capital gain, 0.94. So total after tax income is how much? You get 10 dividends plus 4.722 capital gain. Minus you pay $4 tax on dividends, $1 tax on the capital gain. So you end up with 978. So the after-tax rate of return for the company is 10%. Again, it's not coincidence. This is what I wanted to have. So basically, management of B, it pays dividend. It can reduce dividend payments and increase the stock price from 97 to 100. because A, equivalent firm, it didn't have any dividend payments, and the stock price was 100 for them. So basically, someone said because of the tax. You said that? Okay. Because of the tax, investors are aware that some money will go to the government. That's why they're pricing the dividend-paying stock at a smaller price. That's why it was 97, not 100. So this is what dividends are bad camp are saying. They basically say, if you can get rid of dividends, it's a good thing. It's because governments will not have taxes. What does empirical evidence say? Okay. This is actually very difficult to show. This is what I was going to say. So we are thinking about expected yields, expected returns. These are very difficult to calculate. And also, dividend payments occur 4 times a year. But basically, investors can just not buy those stocks on certain days, like those 4 times, like ex-dividend dates. They can just stay away from those stocks and not pay dividend taxes, basically. If you want to look at evidence from papers, I found very old papers, actually. Litzenberger and Ramaswamy, they show that investors price stock as if dividend income has an additional 14 to 23% tax over capital gains. Miller and Scholz, on the other hand, remember they talk about dividends are irrelevant. They said investors price stock as if dividend income has an additional 4% tax over the capital gain. So basically, in real world, we should see less effect on dividend payout policies if we can fix capital gains tax to dividend tax. And this is actually what we are saying. But before showing you the tax evidence, let's talk about share purchases and taxes. In the share purchases, you buy the stock and you only pay the capital gain tax if the stock price is higher than what you initially paid for the stock. And we can say share purchases have a tax advantage over dividends in general. Dividends are taxed more, let's say, conservatively, let's say. But if all the companies eliminate dividend payments and start share purchases, what's going to happen? The government is not stupid. They will start taxing the share purchases this time. So they're going to play with capital gains taxes. And another funny thing we see is when companies talk about share purchases, they never talk about tax benefits. So they say, our stock is a good investment. We want to have the shares available to finance acquisitions of other companies. They talk about all the good reasons why they are repurchasing stocks, not the tax. Actually, tax has an important implication for payout policy for companies. And also, one little thing I will mention before I will start summarizing things. The worst possible case for dividend payment occurs when a company has to issue new stock to fund the dividend. And actually, this is what Michaely and Miller assumed, right? And in that case, what's going to happen is, in real life, because we have taxes now, in Michaely and Miller there were no taxes. Before we have taxes and transaction costs, we're going to destroy the value of the firm because of the cost of issuing new equity. So you're going to increase the cost to the company to be able to pay dividends, which is a bad thing. And if a company has to face with a decision like that, they'd rather cut dividends instead of issuing stocks to be able to finance their dividend payments. And this is actually what we see. That's interesting. So again, here we see different dividend yields, and here we have new issuances. So normally what we should see is, here we see companies paying no dividends. They have very high stock issuances. Why is it the case? The same thing. These are probably growth companies. They don't pay dividends. They need money. They issue stocks. This is not surprising. Look at this part. This is really interesting. These are companies with very high dividend yields, more than 4.5%, and look at their new issue case. So it's almost like companies are really issuing stocks to be able to pay their dividends, which is a dangerous territory actually. So that's the last interesting graph I'm going to show. Let me give you some blah, blah, blah information about dividend taxes in US. So from all those things, you can take now what happens in US is ordinary dividend tax and short-term capital gains are fixed at the same rate, 15%. So normally ordinary tax rate is around 35%, capital gain rates are around 15%. So they up to 2013, they take ordinary income and dividend taxes the same. Beginning in 2013, they changed it a little bit. They increased the capital gains tax rate for high-income people. Probably it is the Democrat effect in-house. But then we say later years, this is what we're saying. This is the difference between capital gain tax and ordinary income tax. As you can see, in 1950s, there was a huge gap between ordinary income and capital gain taxes. Then they fixed it here in 1986, if I remember correctly. Let's say, yes, 1986. They equalized dividend and capital gain taxes. Then the gap increased again, but beginning of 2000, 2003, they made it same again. So as you can see, actually, whenever we're talking about those payout policies, this has important implications for fiscal policies and tax policies as well. But we can say that companies are using less and less dividends because of many different reasons, and they're using share purchases more. One reason might be the tax effect as well. But I think to be able to say dividends are irrelevant is kind of too much. In the Modigliani-Miller world, we are making lots of simplifying assumptions, and it's not very realistic. And sometimes I say dividends are good, sometimes I say dividends are bad for different reasons we talk about. Some people like money, they like income, they like dividends. They get the money, they use it for consumption, or they get the money for future investments. Or there are some people who say dividends are bad because of tax, double taxation problem. And in that case, share purchases might be a good thing. Again, as I did with the capital structure, I'm not giving you a clear picture of what companies should do because there are lots of decisions related to that. So it's up to you to decide what is good, what is bad for your own company, for your own markets, with the tax system, legal system, and everything. Do you have any questions? Okay, then I will see you next week. I'm going to touch base dividend taxation now, and then at the end of the class, again, I'm going to go back to taxation of dividend payments because they're important. There is double taxation in US companies for dividends. When I say double taxation, what am I talking about? Companies pay taxes on their taxable income, right? Think about the income statement. There's earnings before interest and taxes. Then the company pays interest, and then we end up with EBT, equivalent to taxable income. From that taxable income, taxes paid to the government. So the corporations are paying tax to government at around 35%. And then net income, we find the net income, and then dividend payments are made to stockholders. In that case, as stockholders, we have to pay taxes on the dividend payment because it is it's increasing your income. So because of that, we say there's double taxation in US. So how do you think this tax will affect the value of stocks? In a positive way or in a negative way? So this tax goes to, when I talk about value of stocks, I'm talking about value to shareholders, right? So when shareholders are paying taxes, what happens? Are they left with less money or more money? less money. So it should affect the value of stocks in a negative way, right? Because the tax is going to the government. And we're going to see theories about it as well. Okay, let's look at this example, just mathematical representation of what I just said. Dividend payout, total payout ratios, and everything. There are other types of dividends as well. So there are stock dividends. So basically what happens is companies give each shareholder additional stock. For instance, 100 stock dividend means you have one stock on top of every stock you have. Okay, so you get one more share. 50 stock dividend means you have half a stock for every stock you own. So stock dividends are like stock splits. And I'm going to give you an example later. 100% stock dividend equals to 2-to-1 stock splits. So for each stock you have, you're going to end up with 2 stocks. For 50% stock dividend, it is 1.5-to-1 stock split. For each stock you have, you're going to have 1.5 stocks. No value added by the dividend payments, okay? It's going to change the stock price, of course, but it's not going to change the value of the company. So basically, the stock price will decline, but stock price numbers of shares will increase, and stock price will decrease. So the total effect will be nothing. There are also property dividends. These are really interesting. These are very rare. Made up example, if you have Heineken stock, for instance, they're sending you a case of beer for every 100 shares. But there are real-world examples as well. Wrigley's gum, they send a box of chewing gum to the shareholders. So there are property dividends as well. Okay, let's look at this simple example on a couple of things. One, if I can finish all the slides today, then I'm thinking about having a class next Tuesday, the valuation chapter, and no class on Thursday. Then on the next Tuesday, you're going to have the exam. So on that Thursday, I might have office hours. So if you study in advance, you can ask me questions. Another thing is videos are being put on the internet. The first week's class is already there. I'm going to send you the link. And before the exam, probably we are going to have the capital structure weeks, 2 weeks of lecture as well. The payout part is blah, blah, blah. You can read it anywhere. And I put the sources I'm using. So if you want, you can read those chapters. And then we have valuation left. I don't think we will have many slides in the valuation part. So I think we can finish it in 2 hours. And today I will definitely try to finish before 6. But if I have like 5 slides left, if it is 6, I will continue, of course. But I will try to finish before 6. Okay. We talk about what dividends are, what is dividend yield. And we see that in the Travelers and Citigroup case or Kraft and Altria Group case, this is another way of distributing money to shareholders. So they are giving shares of their subsidiaries, let's say. Another thing, something popular, has become popular in US is DRIPs, dividend reinvestment plans. So basically, companies allow shareholders to invest their dividends on the company again. Why is it good? Because normally you get your dividend payment and then you have to pay commission and what have you to buy stocks. But with dividend reinvestment plan, you're not paying any commissions and you're buying more of the company. So this is good for both parties. And to see why it's important, so if you are getting $30 in dividends in a quarter, when there's an $8 commission to invest the money, you will just prefer to be in dividend reinvestment plan. So you can just pay. You can use that $30 to buy more stocks in the company. This was another reason why when I ask you, would you prefer a dividend-paying stock or not? As you can see, you can get the dividends and make more investments. And with a DRIP plan, you can, if you're happy with your company, if you're happy with the future prospects of the company, you can reinvest in the company without any commissions. So this is getting very trendy in US. Taxing. We talk about capital structure and we talk about how taxes are important on stock dividends. Imagine a corporation. It has 10 million shares outstanding and it is sold at $60. And it declares 3-for-2 stock split. So for each 2 stocks you have, you're going to end up with owning 3 stocks. Okay? So after the splits, how many shares will be outstanding? There are 10 million shares outstanding. Because of the 3-to-2 ratio, the company will have 15 million shares outstanding. But the stock price will be influenced as well. The stock price will decrease to $40 per share. Very simply, why do you think companies might do stock dividends or stock splits? Anyone else? Okay, yes.
For example, the Apple shares, it's just like traded at the 600 or so. So to make it more available to investors, they choose split.
Exactly. If the stock price is too high compared to the competitors, it might be a trouble for the company because investors might not afford the stock. So to decrease the stock price without changing the value of the firm, this is what companies might do. Exactly. Okay, we might also see spin-offs. So what happens is a new company is generated and the parent company investors are paid by new company's shares. So parent company shareholders own parent company stocks and also the subsidiary stocks.